Welcome. In this lecture, we are going to study working capital, liquidity, and the cash conversion cycle. This is one of the most practical topics in finance because it connects accounting numbers with daily business survival. A company may report profits, show healthy sales growth, and even have satisfied customers. But if cash does not arrive when cash is needed, the company can still face serious pressure. That is the heart of working capital management. Businesses pay employees, suppliers, lenders, landlords, tax authorities, and many others. These payments often happen before customers pay the company. So the key issue is timing. When cash leaves the firm before cash comes back, the company needs liquidity. It may need cash reserves, supplier credit, bank credit, or other short-term financing. Working capital management asks a very practical question. Can the firm keep operating smoothly while waiting for cash to return? The objective is not simply to reduce working capital as much as possible. The objective is to maintain enough liquidity to support operations while avoiding unnecessary cash balances, excessive inventory, weak collection discipline, and costly short-term borrowing. By the end of this lecture, you should understand how short-term operating decisions affect financial flexibility, cash needs, and risk. Working capital is the capital needed to run the day-to-day business. It may not be as dramatic as building a new factory, buying another company, or launching a major new product. But without working capital, even the best strategy cannot function. Think about a retailer. Inventory must be available before customers enter the store. Think about a manufacturer. Raw materials and work-in-process inventory must exist before finished goods can be sold. Think about a service company. Employees may need to be paid before customers pay their invoices. In each case, the business must commit resources before cash is collected. This is why working capital is operating infrastructure. On the balance sheet, the basic distinction is between current assets and current liabilities. Current assets are resources expected to become cash, be sold, be used, or be consumed within the normal operating cycle. These include cash, marketable securities, accounts receivable, inventory, and prepaid expenses. Current liabilities are obligations expected to require cash payment within the normal operating cycle or within a short period. These include accounts payable, accrued wages, accrued taxes, short-term bank debt, and the current portion of long-term debt. Current assets support operations, but they also tie up capital. Current liabilities create obligations, but some of them also provide financing. A financial manager must understand both sides of the short-term balance sheet because liquidity depends on how these accounts behave together. Let's now separate two important ideas: net working capital and operating working capital. Net working capital compares current assets with current liabilities. When current assets are greater than current liabilities, the firm has a short-term cushion. This may help the firm absorb uncertainty, delays, or unexpected cash needs. When current liabilities are greater than current assets, the firm may be operating very efficiently, or it may be taking liquidity risk. The interpretation depends on the business model. For operating analysis, managers often go one step further and focus on operating working capital. This means they separate normal operating accounts from financial accounts. Cash, marketable securities, and short-term debt may reflect financing choices, risk preferences, or temporary events. Receivables, inventory, payables, and accrued operating expenses are more directly tied to the firm's operating cycle. This distinction matters because not all current accounts tell the same story. A large cash balance may mean caution, a recent financing transaction, or preparation for an acquisition. A large receivables balance may mean rapid sales growth, loose credit policy, or slow collections. A large inventory balance may mean expected demand, supply chain concerns, or poor forecasting. So the finance lesson is simple. Do not read working capital accounts mechanically. Ask what each account represents, why it changed, and how it affects the timing of cash flows. Many people begin liquidity analysis with accounting ratios. The current ratio and quick ratio are useful starting points. They are static. They describe balance sheet amounts at one point in time. Operating liquidity is different. It is dynamic. It depends on how quickly inventory is sold, how quickly customers pay, how predictable cash outflows are, and whether credit remains available when the firm needs it. A firm can have a strong current ratio and still have weak liquidity if inventory is difficult to sell or receivables are difficult to collect. A firm can have a lower current ratio and still operate safely if it sells inventory quickly, collects cash quickly, and receives favorable credit from suppliers. This is why we need the operating cycle. The operating cycle measures the time required to acquire or produce inventory, sell it, and collect cash from customers. It begins when the firm commits resources to inventory. It ends when cash is collected from the sale. There are two major parts. The inventory period tells us how long inventory is held before sale. The receivables period tells us how long it takes to collect cash after the sale. The operating cycle links business activity to cash timing. A longer operating cycle usually means more capital is tied up before cash returns. A shorter operating cycle usually means the firm converts resources into cash more quickly. Now we add one more important piece: supplier financing. This brings us to the cash conversion cycle. The cash conversion cycle extends the operating cycle by recognizing that suppliers may allow the firm to pay later. This matters because the firm may not have to finance the entire operating cycle by itself. The idea is straightforward. The firm holds inventory. The firm sells inventory. The firm waits for customers to pay. But at the same time, the firm may also be waiting to pay suppliers. The cash conversion cycle estimates how long the firm must finance operations with its own cash or with external financing. A positive cash conversion cycle means the firm pays cash before receiving cash from customers. A negative cash conversion cycle means the firm receives cash from customers before paying suppliers. A negative cycle can occur when inventory moves quickly, customers pay immediately or in advance, and suppliers offer favorable payment terms. A helpful way to understand this is as a timeline. First, the firm commits resources to inventory or production. Then, inventory is sold. Then, if the sale is on credit, the customer pays later. At some point, the supplier is paid. The key question is, does cash leave before cash comes in, or does cash come in before cash leaves? That timing difference creates or reduces the need for liquidity. A long cash conversion cycle means cash is tied up for a longer period before returning to the firm. This can happen because inventory moves slowly. Customers take a long time to pay. Suppliers require quick payment, or some combination of these factors. A long cycle can create several concerns. First, the firm may need more cash or more short-term borrowing to support the same level of sales. Second, liquidity risk increases. Unexpected delays in selling inventory or collecting receivables can quickly create cash pressure. Third, financial flexibility declines. Cash tied up in inventory and receivables cannot be used for other opportunities. Fourth, a long cycle may reveal operating weakness. Slow inventory turnover may suggest forecasting problems. Slow collections may suggest credit policy problems. Short supplier terms may suggest weak bargaining power. But we must be careful. A long cash conversion cycle is not automatically bad. Some firms must hold inventory to provide reliable service. Some firms have long production or project cycles. Some firms offer customer credit because it supports sales relationships. So the question is not simply whether the cycle is long. The better question is, does this working capital investment support value creation, or does it simply absorb cash? A good financial manager does not chase the lowest possible cycle without understanding the strategy behind it. Working capital must be evaluated in context. A short cash conversion cycle usually means the firm converts operating resources into cash quickly. This can reduce financing needs and improve financial flexibility. A shorter cycle may come from fast inventory turnover, strong collection discipline, immediate customer payment, favorable supplier credit terms, efficient operations, and accurate demand forecasting. That sounds attractive, and often it is. But again, interpretation matters. A very short cycle can also create risks. If inventory is too lean, the firm may lose sales because products are unavailable. If credit terms are too strict, customers may choose competitors with more flexible payment terms. If the firm delays payments to suppliers too aggressively, suppliers may reduce credit, raise prices, delay deliveries, or lower service quality. The objective is not to force the cash conversion cycle as low as possible. The objective is to manage the cycle in a way that supports strategy, profitability, customer relationships, supplier relationships, and liquidity. This leads us to one of the central trade-offs in working capital policy: liquidity versus profitability. Holding more current assets can reduce liquidity risk, but it can also reduce profitability. Holding fewer current assets can improve efficiency and returns, but it can increase the chance of cash shortages, stockouts, lost sales, and operational disruption. Finance is rarely about one perfect answer. It is about balancing benefits, costs, and risks. Working capital policy can be conservative or aggressive. A conservative working capital policy uses larger current asset balances and more stable financing. This may mean holding more cash, maintaining more inventory cushion, monitoring liquidity closely, and using more committed or longer-term financing. The benefit is lower liquidity risk. The cost is that more capital may be tied up in lower return assets, and carrying costs may be higher. An aggressive working capital policy uses leaner current asset balances and relies more heavily on rapid turnover, supplier financing, or short-term credit. The benefit is higher potential efficiency. The risk is greater exposure to shocks, disruptions, and financing pressure. Neither policy is automatically superior. A stable firm with predictable demand, strong supplier relationships, and strong access to credit may safely operate with leaner working capital. A young firm, a cyclical firm, or a firm facing uncertain supply chains may need a larger liquidity cushion. This is why working capital needs differ across industries. A grocery or discount retailer may collect cash quickly and benefit from supplier credit. A manufacturer may need to finance inventory, production, and receivables before cash is collected. A construction or project-based business may depend heavily on contract terms and progress payments. A subscription software business may receive cash before revenue is fully recognized. A seasonal retailer may need financing before the selling season and then repay it after cash is collected. So benchmarking must be thoughtful. Lower is not always better. Higher is not always safer. The right working capital policy depends on the business model. Growth can create a working capital squeeze. This is an important idea because many people assume growth automatically improves financial health. But growth often increases the need for working capital. A firm that sells more may need more inventory. It may carry more receivables. It may need more operating support before customer cash arrives. So even profitable growth can consume cash. This is why financial managers forecast working capital needs before growth occurs. If the business normally requires working capital to support sales, then growth in sales will usually require additional working capital. Seasonality creates a related challenge. Seasonal firms may build inventory, hire labor, and spend on marketing before the peak selling season. Cash outflows arrive before the major cash inflows. The financial manager must forecast the peak borrowing need, arrange credit capacity in advance, and plan repayment after cash is collected. This is not just accounting. This is survival planning. A firm can fail not because its products are unwanted, but because it did not plan the cash timing of growth. Working capital management, therefore, connects strategy with financing. It asks, how much cash will growth require before growth generates cash? That question is essential for sustainable expansion. Let's finish with working capital diagnostics and management. Changes in working capital accounts can reveal important information about operating performance, but no single measure should be interpreted mechanically. If receivables rise faster than sales, that may reflect strong growth under normal credit terms, or it may warn that collections are weakening and customers are delaying payment. If inventory rises faster than sales, the firm may be preparing for demand growth or protecting against supply chain disruption. Or it may indicate weak demand, obsolete inventory, or poor purchasing discipline. As payables rise sharply, the firm may be using supplier credit efficiently, or it may be stretching suppliers because cash is tight. If cash balances fall, the firm may be investing in productive growth, or it may be moving toward liquidity stress. Good analysis combines formulas with business judgment. Managers should ask what changed, why it changed, whether the change is temporary or persistent, and how it affects cash flow risk. To manage the cash conversion cycle, firms can improve forecasting, production scheduling, purchasing discipline, invoicing, collection processes, credit policy, and supplier terms. But every action has trade-offs. Reducing inventory too much can create stockouts. Tightening credit too much can discourage customers. Extending payables too much can damage supplier relationships. In practice, working capital management is not only a finance function. It requires coordination among finance, sales, operations, purchasing, logistics, credit, and senior management. The main lesson is this: profit is important, but cash timing keeps the firm alive. Thank you for watching. I look forward to seeing you in the next video.